Hey everyone, welcome back to Corporate Dakota, the place where we make sense of the money behind the big stories and sometimes reveal that the emperor has no clothes. Today we're diving into Reliance Inc. and their latest filing, which is basically a peek behind the curtain at their financial dealings. What exactly did they get themselves into this time? Stick around to find out. Reliance Inc. has filed a Form 8K, which is like a current report for important events that happen between their bigger quarterly or annual reports. Think of it as a heads-up notice for investors about significant stuff. The key date here is August 14, 2025. This is when the main event we'll be discussing happened. Reliance Inc. is the company we're looking at. They operate in various sectors, and this filing points to some important financial maneuvering. This number 00131222 is their commission file number. It's like their official ID with the Securities and Exchange Commission. Their main stock is common stock, and it has a very small value of $1 assigned to it in their charter. Not too important for us, but it's a formal detail. And where do you find their stock traded well on the New York Stock Exchange, a big league place for buying and selling company shares? Now we get to the juicy part, item 1.01. This tells us Reliance Inc. entered into a major definite agreement, a fancy way of saying a really important contract. What kind of agreement? It's a term loan agreement. This means they borrowed a significant amount of money that they have to pay back over a set period. Who lent them the money? Well, a big bank, Bank of America, was the main agent, along with others like Wells Fargo, PNC Bank, and US Bank. So they're working with some major financial institutions. Here's the story. They borrowed $400 million, and the reason for this massive loan was to pay off other debts, specifically their $400 million in senior unsecured notes that were due to be paid back very soon, August 15, 2025. Essentially, they replaced one big debt with another. This is common when a company wants to get better loan terms or consolidate its borrowing. A really important detail here is that this new $400 million loan is unsecured. That means no specific assets like buildings or equipment are pledged as collateral. Also, none of their subsidiary companies are guaranteeing this loan. This makes it riskier for the lenders, but potentially more flexible for Reliance Inc. Let's talk about the cost of this money. The interest rate is tied to something called SFR, which is the Secured Overnight Financing Rate. A benchmark interest rate, initially the rate is SOFR plus a bit over 0.75%. This rate is set until they provide a compliance certificate for the quarter ending September 2025. After that initial period, the interest rate can go up or down. It will be somewhere between SOFR plus 0.75% and SOFR plus 1.25% each year. The exact rate depends on something called the company's total net leverage ratio. Basically, if they borrow more or their debt gets too high compared to their earnings, the interest rate goes up. This is super critical. The only financial rule Reliance Inc. has to follow to keep this loan in good standing is to maintain a maximum total net leverage ratio. This is a key indicator of a company's financial health, showing how much debt it has compared to its earnings before interest, taxes, depreciation, and amortization. If they fail this one test, they could be in default. This tells us the lenders are really focused on how much debt Reliance is taking on relative to its ability to generate operating profit. Like any loan agreement, there are specific things that would trigger what they call an event of default. This means if they break certain rules, the lenders can demand their money back immediately. These defaults cover a lot of ground. They include not paying back the loan on time, not being honest in their statements, breaking any part of the agreement, having problems with other big debts going bankrupt, or even serious legal judgments against them. An ariser liability relates to employee retirement plans, so even issues with those can be a problem. A change of control is also listed, which means if the company's ownership or management structure changes significantly without the lender's consent, that could also be a default trigger. The good news for Reliance is they can pay back this loan early if they want to, either all at once or just a part of it, and they won't be charged any extra fees for doing so. This gives them flexibility if they have extra cash down the line. This filing also mentions Exhibit 10.1, which is the actual full-term loan agreement. This document contains all the nitty-gritty details, but for us this summary tells the main story. This next section, Item 2.03, might seem a bit technical, but it's important. It confirms that the term loan agreement is a direct financial obligation for Reliance Inc. This means it's a debt that's directly on their books, not some hidden arrangement. This is the opposite of an off-balance sheet obligation, which can sometimes be used to keep debt away from public view, potentially masking a company's true financial leverage. So this 400 millions, this is the opposite of an off-balance sheet obligation, which can sometimes be used to keep debt away from public view, potentially masking a company's true financial leverage. So this 400 million won is definitely on their balance sheet for everyone to see. Finally, item 9.01 is where they list all the attached documents. This reiterates the core of the filing. The term loan agreement itself is filed as Exhibit 10 bond detailing the $400 million loan with all the big banks involved. And the report itself is signed off on August 15, 2025, a day after the loan agreement was finalized. The signature here is from William A. Smith, the Senior Vice President, General Counsel, and Corporate Secretary. This is a person in a high-level legal role at the company attesting to the accuracy of the filing. Now let's look at Reliance Inc. from a more eagle-eyed perspective. They just took out a massive $400 million loan to refinance existing debt. On the surface, it seems like they're managing their liabilities and perhaps securing a better interest rate or more favorable repayment terms. However, there are a couple of points that stand out. First, the fact that the loan is unsecured means that if things go south, the lenders have fewer immediate options to recover their money without going through a potentially lengthy and costly legal process. This often means unsecured loans come with higher interest rates to compensate lenders for that added risk. We see the interest rate is tied to SOFR plus a margin which can increase if their leverage ratio deteriorates. The most critical piece of information is that the only financial covenant is the maximum total net leverage ratio. This can be a double-edged sword. On one hand, it gives Reliance Inc. a lot of operational freedom. They don't have to worry about maintaining minimum liquidity ratios or profit margins as long as they keep their debt compared to earnings in check. On the other hand, if this is their only financial test, it suggests that lenders are primarily concerned about the company's overall debt load and might be less focused on day-to-day operational performance or profitability metrics. This strategy could be a bet on future growth. If Reliance Inc. believes they can significantly increase their earnings in the near future, then a higher debt-to-earnings ratio today is less of a concern. However, if their growth plans don't pan out, this could leave them vulnerable. A single covenant might also signal that the company's other financial metrics aren't as strong, making a stricter set of covenants difficult to negotiate. We don't have the company's financial statements directly in this filing, but the structure of this debt issuance gives us clues about their capital structure and their risk tolerance. They are comfortable taking on significant unsecured, though potentially variable interest debt. The immediate need to refinance maturing debt suggests they needed to act decisively to avoid a maturity cliff where they might not have been able to secure new financing. The real question for investors is whether this $400 million borrowed will be used effectively to drive growth and profitability that will allow them to comfortably manage this new debt burden and its associated interest payments. If Reliance can grow its earnings substantially, then this move will look smart. If not, they could find themselves in a tight spot, especially if interest rates continue to rise. So what's my take? Reliance Inc. is making bold moves with its debt. They've essentially kicked the can down the road on $400 million in debt, but have taken on a new, potentially more flexible, but also more concentrated debt obligation. The reliance on just one financial covenant is a significant point to watch. It signals a high degree of trust and perhaps pressure from lenders focused solely on leverage. For shareholders, this means keeping a close eye on not just revenue, but earnings and the company's ability to manage its overall debt relative to those earnings. The strategy is aggressive and could lead to significant rewards if growth accelerates or significant pain if it falters. Alright, that's our decode of Reliance Inc.'s latest financial maneuver. What are your thoughts on this $400 million loan and what it means for the company's future? Let me know in the comments below. If you found this breakdown helpful, please give it a like and subscribe for more deep dives into corporate finance. And hey, don't forget to join our Discord channel linked in the description for more discussions and insights. Thanks for tuning in, and we'll see you in the next video. So